Good afternoon, sir. Welcome to Turkey. Welcome to Istanbul, your city as well.
Yes, it's a pleasure being back here.
Sir, as a chairman of Roubini Global Economics, well-known and economic professor, predicting global recession as well, we are going through very interesting days in the financial markets, and probably whatever you said in the last 2.5 years' time, most of them happen, and we have been observing them at the market right now. So my first question would be coming from the United States. What do you think that Bernanke may say today, when we are getting towards the end of the Q2?
Well, there is a meeting of the FOMC, and it's the first time that also Bernanke is going to have a formal press conference. I think part of it is because we're getting close to the end of QE2, and there are many questions in the markets about what's going to be the exit strategy of the Fed, whether they're going to first run down the balance sheet or whether they're going to start raising rates, and with which sequence and timing these things will be done. Then the press conference is probably the beginning of being able for Bernanke to give greater signals to the markets and investors about what's going to be the exit strategies and the conditions for it of the Fed, something that he can flesh out in some more detail than the FOMC statement.
So as you say that this will be quite critical FOMC meeting, that let's imagine that we'll come to the end of June 30th, which will be the end of Q2 program. What would you expect to see when the Q2 ends, and if Fed will not continue another quantitative easing program?
Yeah, most likely there is not going to be QE3 unless the economy goes back to stall speed. There's not going to be QE3 because growth is okay. Inflation, however, gradually is rising. The Republicans in Congress are bashing the Fed, in my view wrongly, saying that the Fed is debasing the currency. And also 3 out of the 4 new members of the FOMC, Kocher, Lakota, Plosser and Fisher, are more hawkish than Ben Bernanke, Janet Yellen, and the center of the committee. So we're not going to have a QE3. And then the question is how fast we exit from zero policy rates. My view of it is that first they're going to reinvest the maturing RMBSs. Then at some point down the line they're going to allow the roll-off of the RMBSs to occur. Then they may start also to reduce further the balance sheet by doing reverse repos and some sale of the long-term bonds that they bought. At some point they're going to drop the extended period for zero policy rate that is in the statement, and then down the line at some point in 2012 they may start to raise the Fed funds rates and or the interest rate on excess reserves. That's going to become the main tool of monetary policy as a way of sterilizing the excess base money. So there's going to be a sequence of these things happening, but the sequence and the speed of it is going to depend very much on how much there is upside or downside risk to economic growth and also to the inflation rate. So part of it is going to be very much data dependent and state contingent.
So, Mr. Roubini, you mentioned that economy seems okay and the economy is picking up as well. But at the meantime, IMF recently downgraded United States growth for 2011 as well. So from this perspective, would you like to say that Q2 was successful, it succeeded?
Well, Q2 was successful in the sense that last summer there was a risk of a stall speed, and the combination of QE2, the fiscal stimulus and some better data led to a recovery of growth. And QE2 worked not through the credit channel, but rather by weakening the dollar, leading to asset reflation in the stock market, reducing credit spreads, and also increasing expected inflation that was very low. So that was the channels of transmission of QE2. In that sense, you could say it had a partial effect. Still, the economy is still growing anemic, subpar, below trend. I expect that growth this year is going to be at best 2.5%, when potential is 3%. First quarter growth actually is going to be worse because we've had these headwinds coming from oil and other shocks, so it could be as low as 1.5%. the rest of the year is going to improve, but in my view, because of this is a balance sheet recession, there is still balance sheet deleveraging of households, of the government, of state and local governments, even of financial institutions. The recovery is going to remain subpar, anemic, below trend.
So there is a big criticism on this side of the ocean, especially on the emerging markets, including Turkey as well. BRIC countries, Turkey and other countries, they all keep saying that U.S. is exporting inflation while trying to improve its economics. Do you think that this is a valid criticism?
Well, I think it's only very partially valid because the U.S. decided to do QE2 at a time where the U.S. economy was reaching a stall speed, and would have been much worse for emerging markets and for the rest of the world if that U.S. economy was going back into a double-dip recession. So it's true that easier money weakens the dollar and makes the U.S. more competitive, and it leads also to some increase in commodity inflation. On the other side, the recovery of the U.S. economy means more imports, so the net effect on the U.S. trade balance is a wash, and therefore the net effect of emerging market is neither negative or positive, and the worst thing could have happened to emerging market would have been if the U.S. had ended up back into a recession. Also, this issue about exporting inflation is that the U.S. is following a certain monetary policy, but if China shadows the US dollar and every emerging market shadows the Chinese currency, of course they tend to adopt too easy monetary policy. What's good for the US, near zero rates, is not good for a country like China is growing almost like 10% or Turkey 9%. Therefore, these countries have to allow more flexibility of their exchange rate to regain a monetary and credit independence. They cannot blame U.S. monetary policy for their own asset bubbles or credit bubbles or inflation, because they have the tools as long as they allow more exchange rate flexibilities to control those inflationary and credit pressures.
Mr. Roubini Global Economics is surveying Turkey economies very closely as well, and Turkey is struggling with the current account deficit, something like 6 to 7%. Do you think that Turkey can continue with high growth current account deficit as long as he can fund itself from the capital markets?
Well, so far there was a large current account deficit, but has been financed with capital inflows, both debt and equity and portfolio and foreign direct investment. What is becoming a little more risky in the case of Turkey is one, that current account deficit is becoming larger. It's becoming larger not only because there is a rise in oil prices, but also because there is a lot of aggressive increase in domestic demand that is fueled by excessive credit growth. So you have a current account deficit now could become 6, 7, maybe even 8% of GDP this year. It's also being funded increasingly less with equity and more in debt, less with foreign direct investment and more with shorter term portfolio inflows. And those debt inflows tend to be now shorter term and also more so in foreign currency and more so intermediated through the banking system. That is the other side of this excessive loan growth and credit growth in the economy. So both the size of the deficits and the way it's financed and the implication for excessive credit growth imply a greater degree of financial fragility. We're not yet at a tipping point, but certainly the large deficits, its financing and excessive credit growth should be a matter of concern for central bank and regulators in Turkey.
Mr. Roubini, our last minute, do you see any danger of balloon on the commodity market as of these prices?
Well, commodity prices are in part rising because of fundamentals of high growth in emerging markets, demand growing more than supply. Oil and energy prices recently have been rising also because of the oil shock from Libya and the fear premium that there'll be more turmoil in the Middle East, leading to, again, rise in oil prices. Some of that increase in commodity prices may also be due to this wall of liquidity with zero policy rates in U.S. and advanced economies chasing assets in emerging markets and also chasing commodities. So there is some degree of frothiness in some of these commodity markets as well.
Nouriel Roubini, thank you so much for joining program, sir. Enjoy the rest of the day in Istanbul.
Pleasure being with you.